All right. Well, welcome everybody. Thanks for joining us today in our virtual KWB cabin in the mountains. Yeah, my name is Darren Buma. I'm one of the business partners here at KWB, and part of our mission at KWB is to help clients achieve their goals. And one of those, almost universally, is to reduce taxes and ultimately maximize the value of their estates. So today we're going to share some, maybe a little less traditional approach to reducing taxes, discussing how different products available through the insurance industry should be considered as part of your overall tax planning strategy. It's about generating more wealth for you and for your state, in part by reducing taxes, but and then also protecting your assets along the way and giving you and your family additional peace of mind. So today I'm here with my business partner, David Wickenberg, and David has some great experience in this area. So I'm going to be asking him a number of questions. You may have some questions along the way. It's a relatively small group, so feel free to jump in if you have them. You can throw them in the chat. Samantha will be monitoring that. Or wait till the end, and as David mentioned earlier, we're likely going to have some time at the end of this so we can cover those off. All right, so let's get going. David, we've traditionally looked at insurance as a risk management tool, so protecting us from unexpected events, as well as the expected ones like death and the income taxes that arise from that. So what's changed in our thinking in that regard?
Yeah, it's a fair bit for me in the last year or so. And first off, what I'd like to do is start using some terminology that might help us think of it a little differently rather than insurance. When we are discussing this more as an investment option, tax planning option, we like to describe it as a corporate tax-free investment account, because really that's what it is. And that's how it works. It's very similar to how a TFSA works, actually.
Interesting. Tell us a little bit more about that.
So just like a TFSA, you put after-tax money into these corporate TFIAs, and they'll grow tax-free. You can take money out tax-free, and we'll get into how that can be done. And eventually, it'll all come out tax-free. These benefits have been around for a long time. They're not new. They're a result mainly of the insurance industry working hard to get special tax treatment for these products. The specifics behind this are that when you have what's called a participating whole life insurance, or PAR for short, so you sometimes hear people talking about PAR policies, etc., you can contribute extra money beyond the premiums to earn tax-free returns on those investments. So there's a minimum amount that's the insurance component, but then there's the ability to add additional monies to that. What's usually done is that after the first few years of these extra deposits, the tax-free earnings are often used to cover future insurance premiums. And that's why often after 10 or 15 years, the premiums for the insurance are paid through the ongoing earnings of the corporate TFIA. And that can continue for much, much longer.
All right. So if someone is investing additional funds into one of these TFIAs, is that money tied up and out of reach should, they need it at some point in time?
Yeah, so I used to think so. And that's one of the biggest hurdles that I had with my thinking around these products. But learning about it a lot more over this past year is I found out that a corporate TFIA can be used as collateral, providing access to funds that can be gotten to if needed. The nice thing is that it's then a loan. Well, a loan to the company is not taxable. So that's how we talk about the money coming out tax-free during the time that you have the policy in place if you need it.
Okay, so the corporation could take a loan against the policy, But what about the individual? So, if the individual shareholder has a need for access to that money personally,
Yeah. So
does that, come out, is that available tax free?
well, typically not. The premiums, contributions were made by the company, so it's the company's asset, right? So it's the company that would get the loan. However, I have heard, discovered, kind of prodded and questioned, and it might be possible to arrange to pay a collateral fee to the company. So basically, you're saying, hey, let me use this asset as collateral. I'll pay you a fee for that, and then the bank will lend you personally the money on the corporate asset. And then that's seems to be allowed. I don't think it's used too often, but it is a possibility, and it's something that if somebody was looking to do something like that, we could look at it and go from there.
Yeah, so you'd have to evaluate whether the additional fee economically makes sense. But I suppose that, I mean, the corporation could borrow the money and then provide a taxable dividend to the shareholder, really in the same fashion as they would from a traditional non-registered investment account.
Yeah, absolutely. And then, it'd be up to us to, do our tax planning magic and figure out the best way to get that money out of the company over the remaining years. And one thing I was going to add is that, if that money does come out to the individual tax free, it's usually later on, like much later after the policy's been around for a while, but that timing can work out great because it's like sort of the later years, maybe in your 80s, maybe in your 90s, like if you've kind of live past what your original projections were and things like that. And it can be a great tool at that time for sure.
Yeah, yeah. This would be a great time for you to maybe give the group a real world example where you've seen this working.
Yeah, so I actually have a fairly recent situation. The policy we set up isn't recent. That was set up about 15 years ago. But I was talking to a client, I think it was in early December, and we were talking on the subject more of planning for the business because the business that he's running, he's starting up a new venture on the one side, and we were talking about how that was going, and it's like any typical startup, it's pulling cash and needing funds, and he was talking about some other planning and maybe cashing in some investments and other things like that. And I said, well, what about your insurance policy? What about this TFIA that you've got? Could we, what would you think about if we borrowed against that? And he was like, whoa, I didn't know we could do that. And so we looked at it, and sure enough, there's plenty of collateral there. So he's going to borrow $250,000 against that TFIA. It's going to come into the company, and it's going to help fund this new venture throughout 2025, rather than him cashing in investments or doing other types of borrowing.
Great. Yeah. Well, knowing that there's access to the money, I think is really important in the decision to participate with these. And we started off, talking a little bit about some tax advantages, and now, insurance in our minds has always been it's a cost, right? Let's maybe you can explain to us where some of the tax advantages come in.
Yeah. So first off, in these products, investment returns are non-taxable, so the portfolio grows tax-free. So instead of losing 25, 30%, each year to CRA, you're compounding and it's growing tax-free. The other thing, depending on the business that you're in, this doesn't affect everybody, but it can affect some that we're talking and working with, is that the government introduced some new tax rules a few years back that said, if you have too much investment income in your company, we're going to grind down your small business deduction. So you won't get the preferred 11% tax rate that most small businesses get. So moving some of this investment income out of your company's normal investment account, non-registered investment account, into this insurance product is a good way to help preserve that small business deduction. And then thirdly, significant long-term tax savings on death, because virtually all of the proceeds that are received at that time create what's called a capital dividend account and will come out of the company tax-free. And normally the pulling the money out of the company would cost you anywhere up to 42% on a dividend.
Yeah, so that's significant because on a $1 million payout, we're talking $400,000, worth of tax savings.
Oh yeah, saves a lot. And all of these planning techniques help in removing, and this is some other terminology that you might hear, but help in removing what we call trapped money from the company, because companies built this money up. Maybe it's got investments, other assets, but it's not accessible to the individual. It's trapped up in the company. And it's a trick getting that out, because like I say, it's anywhere from 30-40% tax on that. Using some tools to get that trapped money out with no tax it has huge implications.
No, that's great. So the premiums, the contributions that you're making into this account, any tax deductions there?
Yeah, well, typically not. The premiums themselves are usually not deductible. The extra contributions are an investment, so that's not an expense either. However, there is an exception to the non-deductible rules, and that is that if you have lending and the lender requires you to have life insurance, then the premiums can be tax deductible. So, this is where you may, if you've got a good relationship with your banker or another lender that you've got funds with, you may go to them and say, hey, maybe you need to have me have life insurance, and talk to them about that. And if they put that as a condition of the loan, now that those premiums can be, or at least a portion of those premiums, because it depends how much the loan is and how much the policy is for, but at least some of that, those premiums could be deductible.
Well, and I could imagine that offering to provide some additional security to the bank would be comforting to them and may even result in a slightly lower financing rate.
Yeah, yeah, all in the negotiations.
Yeah. So when should someone consider looking at this and starting to, invest and contribute to a corporate tax-free investment account as part of their strategy?
Yeah. Well, really, I mean, any time that you have available cash to invest, right? And that could be you're sitting on a lump sum. You might already have other investments, significant other investments. And we're just talking about maybe moving some of those over from your regular non-registered investments into something like this. Or if you've got ongoing cash flow, maybe you don't have a big pool of assets or investment cash, but you're generating $500,000 a year of income, right? And you can allocate some of that. So really, anytime you have cash to invest, because there's multiple benefits in entering into one of these corporate TFIAs. Future, as I've mentioned, future investment returns are tax-free. Policies protected from creditors. That's another key one, right? If it's unregistered and in the company, maybe it's at risk if something bad happens and something goes sideways, right? I mentioned you reduce the amount of taxable income and the special tax treatment on the life insurance proceeds at the end. And often, because of all of those benefits, depending what you choose to invest in, because like many investment options, you can choose to invest conservatively, moderately, aggressively. But depending what you choose, if you compare it to the same type of investment non-registered, the overall returns provided by the corporate TFIA will usually almost always outperform those other investments in the long run.
Yeah, so that sounds great. So now I know that I'm going to have clients talking to me about this and think that they should be putting as much money as they can into one of these things. What do you say about that?
Well, like anything, you don't want to put all your eggs in one basket, right? Same is true for this. It is a very strong, very attractive investment option. But I wouldn't put, I wouldn't recommend, that be your only investment in your portfolio. Should certainly be one of them, I think, from what I've seen. It belongs in virtually every investment portfolio. But yeah, not solely, or not even, like a majority of it. So
Yeah. And
I'm
this is a longer term play, or these have a longer term outlook, right? So although that, you can get access to money, this is really funds that are in surplus to your retirement needs, and really money that you're intending to leave to your estate and to your beneficiaries, right? And that's, that's where the real value comes in. And I think it's important for people to realize that, and not, again, like you said, not all eggs in one basket, but not, I do have clients, unfortunately, that were talked into something that was more than what they needed. And now it's, they're a little challenged because their kids are going to do great. but but uh but the parents, not so much at this point in time.
Yeah, and that's why it should be part of, but not the entire thing. I've been talking with a number of people in the last 6 months, some of them with significant portfolios, and we're definitely talking about, shaving off 10 or 20% of that, and, moving it over into a TFIA. But you're absolutely right. They want to have flexibility and that kind of thing. And the nice thing is, but what we've discovered, and as we dig more and as we push and prod and ask questions, we're learning how these products can actually accomplish a lot of that stuff.
Right, right. Thanks. Great. So do you have some further examples of tax-free investment accounts that have been set up, and what people are expecting as an outcome?
Yeah, for sure. So, anticipating this, I went through and looked at some things that we've done recently, and what others that we work with have looked at, and we put together I've got 3 examples here, different ages, different, parts of their life, where they're at. So this first one, and we could get into tons of detail here. There is a lot of detail, and when we're looking at individual and doing individual planning, we do that. We get into the detail, and we make sure that everything is understood, and we look at virtually everything. But for these examples, I've summarized quite a bit. So this one is a couple in their late 50s. He sold his business for about $1.5 million. They were going to use that to get to about $2 million, and at $2 million, they felt that they would get the investment returns they needed to retire. So right away, they spent a bunch of money, helped out the kids, did some other spending for themselves, and all of a sudden it was down to 1.1. And they're like, oh, what's going to happen now? What can we do? So they approached, the planner that we work with, and they revised the plan to move a lot of these investments out of the non-registered assets into RSPs. And another key thing was this joint first to die policy. And this is a key part of the plan, because the joint first to die is not necessarily a hugely common product that's used. But in this case, what happens is it's going to provide a tax-free benefit of almost $500,000 to the survivor, right? Whichever of the two is remaining, which ensures the financial stability for the survivor, and shelters their assets and helps reduce the taxes on this as well. That helped to kind of put their path or their plan back on the path, leveraging these tax efficient strategies and using the TFIA, so that they're back and able to retire when they'd like, maintaining the lifestyle that they wanted to maintain as well.
Yeah, good plan.
And another one that I've personally been working on is over the last 3 months is I'm working with a physician, 41-year-old doctor. Initially, his goal is to retire at around age 55. But he had a setback last year to these plans. He ended up in a divorce situation, and basically was left with minimal personal and corporate assets. in the settlement, that's what happened. He's left with the ability to generate cash flow and generate earnings, and so he's earning about $500,000 annually. And although his original plan was he was going to pay off the mortgage, invest in the company and non-registered, what we've now looked at is said, if we do that, some of that still, but open up a corporate TFIA, do a critical illness CI plan, reallocating some of the annual earnings into these tax sheltered investments and other ones like the TFSA and RSPs, we'll be able to get him back on track where he can retire at 55. If we hadn't done anything, it was modeled out that he would probably have to work until he was 60, right? So an extra 5 years to meet his goals, right? So he'd either have to lower his expectations, or he was looking at another 5 years of working in the hospital. So now he's back on track to retire at 55. And the other cool thing is that when he hits 55, he should have a cash value in the TFIA of about $1.25 million. The plan is he won't need to touch that. That's going to grow to like over $6 million by the time he hits 100, if he hits 100. And he's also going to be able to pull out $700,000 tax-free when he's 55 because of the critical illness policy that's put in place. So it gave him all this added flexibility. And the big kicker is that he doesn't just run out of money, when he's 90 or 100. He's actually going to have, the $6 million more because of what's been done. Right. So.
Great. You introduced the concept of critical illness there, and we'll come back to that later. I'll want to ask a couple more questions about that.
Sure. And I have one last example. It's an older couple, 73-year-old professional, retired, his 72-year-old wife. They have the 1.2 million in RSPs, another 1.3 million in corporate assets, feel more than comfortable that they've got sufficient investments to live off of in their retirement. The house is paid for, their living expenses are modest, so they were very comfortable with that. However, it was worth looking at in their situation because of this trapped income that they've got in the company, right? So this 1.3 million in corporate assets, they were going to have to pay, between 30 and 40% to get it out. And so by using a TFIA through a joint last to die policy, they were able to get, not only some insurance coverage, which was great, but they're going to be able to increase the value to their estate with the planning that's happened. The estate's going to have an extra $1.1 million than it would have had. And kind of to your point earlier is that when you implement a lot of these things, maybe not, you're going to have a big benefit to the, to the people that are doing it. But it's about shifting the assets away from CRA and into, your estate, the charities that you want to support, those kinds of things. And with very little change in, almost no change in your retirement lifestyle.
Great. We're talking a lot about investing. There are, of course, other and life insurance, and there are other risks in life, such as getting sick or disabilities. And these things can have even greater financial hardship on somebody or on a family because of the business owner being unable to work and earn an income, right? You talked a little bit in your second example about critical illness. So, like what other things should clients be thinking about on the risk management side?
Yeah, there's two that we always look at a minimum, especially based on age and if they're still working. Critical illness for sure. For those that maybe don't know, critical illness is a type of insurance that pays you a lump sum of money if you're diagnosed with a serious health condition covered by that policy. And you'll need to read your policies to make sure all the things you want are in there. It's usually a list of 20 or more. It can be used for anything since it gives you a cash payout if you qualify. So it isn't, a policy that says we'll pay for the hospital bills or we'll pay for the surgeries or things like that, right? You just get the payout. The really nice thing is that they're usually paid out fairly quickly. So you don't have a 6 month or 12-month waiting time. 1 or 2 months is sort of typical from what I understand. And they include, or they cover under the policy, things like heart attack, cancer, stroke, kidney failure, major organ transplants, and a lot of other, serious medical conditions, right? So, and then disability insurance is the other one that we look at. And just again, for those that maybe don't know as well, and it should definitely be considered depending on your age and your personal situation. But disability insurance replaces a part of your income if you can't work due to an illness or injury. Right? Usually, and it can be set at different levels, but it's usually 50 to 70% of your regular income. It can be short term. I don't know if a lot of people knew that, but it can be short term up to like 6 months, or longer term, which is the norm, usually up to about age 65, end of working years. It does take a little longer to kick in compared to CI, but that's what it's used for.
Yeah, great. So when's the best time for someone to look at acquiring, some of these products, life, critical illness, disability?
Well, typically the sooner the better. They rate you based on age, based on other factors, male, female, smoker, non-smoker, things like that. So, as you age, the premiums tend to go up. So the younger you are, the better it is. Which means that you could get more insurance for the same premiums or less premiums, and it's also easier to get coverage. Unfortunately, there have been cases where somebody's waited, and by the time they go to get coverage, maybe something's happened. Maybe they've had a stroke, maybe they've had a heart attack, maybe they've been diagnosed with cancer, something like that. So had they gone and got the policies in place before that, they'd be in place, and now they're unable to get it.
Right. So, in your third example, you had a couple that were in their early 70s. So we don't often think of people going out and acquiring insurance at that life insurance at that point in their life. Um, so tell us a little bit about that. Like, so if somebody's older, or maybe somebody doesn't have the best health, are they out of luck with this, or is there some opportunities yet?
Yeah. So this is where it's a shift in mindset, right? And the paradigm that you've got around this, because we're not looking at it as much as a insurance risk management tool. We're looking at it as a tax planning tool, right? And so the fact that the premiums might be higher isn't a bad thing. Ironically, acquiring insurance later in life has its own advantages, or even if you're not in the healthiest condition. The investment portion, I was talking about, there's the premium portion, and then there's the extra that you can add on, the investment portion. The investment portion is actually based on how much your premiums are. So ironically, if your premiums are high because you're older or because your health isn't great, the amount that you can invest is higher as well. So sometimes there can be an actual advantage from the tax planning perspective to have those high premiums. And so, starting an insurance policy, even at, an advanced age, or if the health conditions exist, can still be beneficial, especially if the purpose is coming back to that, getting out that trapped income that's in a company.
Right. So, aside from the investing advantages, just remind us some of the other benefits of a corporate tax-free investment account.
Yeah, so although we're focusing on it as a tax planning and investing tool, it does provide risk management. So life's unpredictable. We don't think we're going to have a critical illness. We don't think we're going to have disability. We don't think we're going to die. But a TFIA provides protection against job or income loss due to all of those things: death, illness, or disability. It helps secure you and your loved ones during those tough times. and ensures you've got the resources to, to deal with things, right? Whether it's the money to deal with a critical illness, you're off work for 6 months or a year, you're disabled and you need to pay for things and you're just not able to do as much work, or unfortunately, you've passed away and your wife and kids still need to be supported for another 10 or 15 years, right? So it does, when we look at it as a tax planning tool, and it provides all those great tax advantages and great investment returns, when you look at it on a net basis, the insurance portion is almost like an added benefit, right? So it's like we used to look at it that insurance was the driver and the investment was a benefit. And now I'm looking at it more like the investment is the driver and the insurance is an extra benefit.
Yeah. So going back to my opening comment, again, it's that shift of mindset from looking at insurance as a risk management strategy, to more of a long-term investment strategy. And, really we're just saying it's so much more, right?
Absolutely. And that's why at the beginning I like to say, let's think about it differently. So let's even call it something different. Let's not call it insurance all the time. I mean, it's underwritten with an insurance policy and that sort of thing. But when we talk about it, we like to talk about it as a tax-free investment account in the company.
Yeah. So one gets all the values we discussed, and yeah, you still get the traditional protection against all these life's risks.
Yeah. Yeah. I mean, for sure. And like I say, you hope you never need it. You hope that, we don't have death, sickness, or injury. But you know what? We're grateful in those situations there where it happens, and it's been put in place. I got a good example. A colleague started a CI policy, critical illness policy, 8 or 9 years ago as a tax planning tool, right? And to get the premiums back and tax free out of the company, and had set up a policy for both himself and his wife. And maybe 5 or 6 years ago, so 3, 4 years into the policy, his wife was diagnosed with cancer. And he received a payout of $250,000. And that helped to, cover some expenses, but also allowed him, I guess that's it, is allowed him to have the freedom, to take time off work for a while, not worry about it. She was off work for a number of months as well. But, they didn't feel the hardship, the burden of like, okay, now we have to live off of savings. Now we have to borrow. Now we've got this hole that we've got to get ourselves out of when things are back to normal, right? It's like it kept their lifestyle and their stress down a significant amount.
Yeah. No, thanks for sharing that. Okay, so if someone's interested in looking into these strategies, where do they go? Do all insurance brokers understand the nuances of what we're talking about here today?
Yeah, so unfortunately, a lot don't. A number do for sure. The reality is that large number of people in the insurance industry, don't look at it this way. They focus on the insurance portion, the risk mitigation part of it, the tool, which is understandable. That's how I always thought of it as well, and I think many of us think of it. There aren't too many that focus on it as a tax planning tool, but there are some, for sure. And we've done a good job of, sort of finding and working with those people, so that, if we need to, if people are interested, we've got great professionals we can turn to. Because we brought ourselves up to speed on this as well, we help provide personalized, guidance and help evaluating the solutions that are presented. So, we can either help put the plan together, we can take a look at the plans that have been suggested, put together by other professionals and evaluate and, just ask the tough questions. Usually they're well done, and but the individuals might not know the questions to ask and might feel hesitant or unsure or worried about it. And so just getting everything out in the open by asking the right questions can help. And it is just part of, as we've talked about, it is just part of the investment plan. and the financial plan, right? And so it needs to be part of the proactive advice that we tailor to your unique goals and circumstances. So we do work alongside other financial planning professionals to deliver those comprehensive solutions to give that peace of mind and security. And we'll tailor or we'll recommend those that we think would work best for you.
Yeah, and I think the other important thing is not just the selection of the individual involved, like the broker, but their understanding in the products themselves, because not all products are the same, and some are tailored depending on what the individual client's needs are. Some are going to be tailored to better fit that need than others, right? So it's not I know from my experience, there isn't a single insurance company with a product that would be the right one for everybody, right? And having that understanding and skill set is really, really important.
Well, I would agree with that, and I would even say as well that's what's really important is finding the professionals that understand the integration with companies, and corporate holdings. It's it's a simple situation to look at an individual and talk about insurance needs, but you start involving a company, maybe an operating company along with a holding company, maybe other corporate structure, like those are not simple, right? So finding somebody that can understand how that is all working and what products will work the best for that and get this trapped income out is really important.
Yeah. Well, thanks, David. Appreciate you joining me here today and sharing your insights with the group. And
all right, well, thanks everyone. If you have any questions, fire us an email or get in contact with Samantha, or info@kwbllp.com is our generic email. Reach out if you need anything or have any questions.